Hello, I'm Ali Reza Talebi. I help smart people like you make smarter financial decisions. Thank you for watching. What comprehensive financial planning actually means. Many people think financial planning means choosing investments. For sure, investments matter, portfolio design matters, asset allocation matters. But investments are only one part of your financial life. If your financial plan is only about investment, it's incomplete. A real financial plan connects income, spending, taxes, investments, retirement, insurance, estate planning, employer benefits, family goals, behavior, and professional coordination. Today, I want to explain what comprehensive financial planning actually means and why it matters, especially for educated professionals and high income households. Your portfolio is not your whole financial life. Let me start with a simple idea. Your portfolio is only one chapter of your financial life. It's an important chapter for sure, but it's not the whole book. You may have a good portfolio, but you still have tax problems. You may have a good income, but poor savings habits. You may have a strong retirement accounts, but weak insurance protection. You might have investment assets, but outdated beneficiaries. You might have a retirement projection, but no estate plan. You may have tax-efficient investment, but no strategy for Social Security, Medicare, withdrawals, or Roth conversions. I believe now you got the idea. That's why comprehensive planning matters. The goal is not to optimize one piece in isolation. The goal is to make the pieces work together. So, a complete financial plan actually connects the pieces. What are the pieces? Comprehensive financial planning starts with a full financial life audit. Where are you today? What do you own? What do you owe? What do you earn? What do you spend? What risks are present? And these are actually setting up the initial understanding of your financial situation. We then look at the retirement readiness. Can your future income, assets, taxes, spending, they can support the life you want? The next step is looking at your investment. Are your investments aligned with your time horizon, goals, risk capacity, tax situation, and behavior? Step four is about the tax award planning. This doesn't mean your financial planner actually replaces your CPA, but it means major financial decisions should actually be reviewed for tax impact before they happen. So here we need a very good collaboration between the CPA, the financial planner. So we need to have a team. The next step, cash flow and saving. These are also critical. A plan does not work if the household cannot save, manage spending, or maintain liquidity. Risk management and insurance matter. Why? Because one disability, death, lawsuit, health event, or business disruption can actually damage years of progress. Next one, estate planning and beneficiary review is very important. They help reduce confusion and protect family. Next one, employer benefits. For sure, the employer benefits matter because many professionals have retirement plans, insurance options, equity compensation, pension plans, deferred compensation, or other benefits which actually they need to be reviewed. If you have kids or dependents, education funding should also be a major milestone in your financial strategy. And finally, comprehensive planning includes behavioral coaching, annual assumption review, and coordination with CPAs, attorneys, and other professionals. That's the full picture. I've seen several cases that clients come to me and ask me for my advice on buying or selling a specific stock or investment or retirement plan. But remember, one decision can affect many areas. For example, suppose a client wants to sell appreciated stock to reduce the risk. So, okay, the stock has already been going up, so I want just to make some money. From the investment perspective, that makes sense. But what about federal capital gains tax? What about California tax or other states tax? What about the net investment income tax? What about cash flow needs? What about charitable giving opportunities, estate planning? What about whether the sale should happen all at once or over multiple years? A decision that looks simple from one angle might be very complex when we consider all the dimensions and we look at that comprehensively. Another example, the clients, for example, want to um, retire. That's not only a portfolio question. We need to review spending, Social Security, healthcare, Medicare, taxes, long-term care, and emotional readiness. That's why isolated advice can be very dangerous. A good decision in one area can become a poor decision if it creates problems somewhere else. I just talked about the retirement example. Let me just be a bit more specific. Retirement is one of the best examples of comprehensive planning. Many people ask, do I have enough money to retire? That's for sure an important question, but it's not enough. You also need to ask, what will you spend? What income sources will you have? When should you claim Social Security? Do you have a pension? How will you handle health insurance before Medicare? How will Medicare premiums affect cash flow? Which accounts should you withdraw from first? Should you consider Roth conversions? What's the tax impact of your withdrawals? How will you handle market decline early in retirement? What happens if one spouse lives actually much longer than the other one? What happens if long-term care is needed? And how will retirement affect your identity, purpose, and lifestyle? That's why retirement planning is much more than just picking investments. It's a coordinated life and financial transition. I talk about the comprehensive planning. Now, the question is, what actually the comprehensive financial planning should cover? A real plan should answer several key questions. First, where am I today? You need a clear picture of your current assets, liabilities, income, spending, taxes, insurance, estate documents, and benefits. If you don't know where exactly you are, it's very challenging to set a plan to achieve your goals. Second, what are my goals? The plan should connect to retirement, family, lifestyle, independence, giving, legacy, career, and peace of mind. The third step here is uh, you have to consider risk. What risk could damage the plan? This might include disability, death, inflation, taxes, market declines, lawsuits, debt, concentration risk, health events, or family obligation. The next question we have to consider is about tax consequences. Taxes affect retirement contributions, investment sales, Roth conversions, charitable giving, stock compensation. They also impact on our estate planning. So they're very critical. The next question we need to ask ourselves here is, what should I do first? A plan should prioritize action. Not everything has the same urgency. The sixth question here is, who else needs to be involved? Sometimes the CPA, sometimes you need to have a state attorney or insurance professional, mortgage specialist, or business attorney should be part of the conversation depending on your case. And last but not the least, how will we monitor the progress? The financial plan is not a one-time document. It should be reviewed as life changes. So we recommend at least once a year, or if there is a major life changes, we need to review that meanwhile. So let's say you are sitting with your financial planner or advisor, and You want to make sure actually you are going to receive a deep, comprehensive financial plan. So you have to ask this question from your planner or advisor. You need to ask him or her, do you review taxes? Do you coordinate with my CPA? Do you review insurance? Do you review state documents and beneficiaries? Do you help with employer benefits? Do you provide written recommendations? Do you help with implementation? So these are all the questions we need to ask your advisor. I've seen in so many cases that when the clients come to me and they say, for example, I talk to a specific advisor or planner, and we just talk about investment, or we just talk about the retirement or insurance, but it's not gonna give us a comprehensive approach to prepare and plan for your future. These questions, for sure, they matter because many people receive investment management but not comprehensive planning. A comprehensive planner should help connect all these dots. Just let's review what we mentioned in this video. So I understand when it comes to investment, usually that's the most appealing and most obvious part of financial plan. That's why so many advisors or clients, they might be more interested to focus on that part. But remember, the investment, the portfolio is only one chapter of your financial life. A comprehensive financial plan should connect all the chapters: income, taxes, investments, retirement, insurance, estate planning, benefits, cash flow, and behavior. The goal is not to optimize one area while ignoring the rest. The goal is to make the whole financial life work together. So before you ask only, how are my investments doing? You should ask this question: is my full financial plan ready, prepared, and working?